Welcome to the Deep Dive. This is where we take a whole stack of sources, research papers, articles, notes, you name it, and really boil it down for you. We pull out the key insights, the surprising facts, kind of give you that shortcut to being genuinely informed, maybe with a little humor along the way. Today, we're diving into a company that's, well, right at the epicenter of the AI revolution. Its stock has been absolutely electrifying. Bloom Energy, ticker BE. Now, the big question we're tackling is this. Is Bloom Energy truly the critical key unlocking AI's future? Or is its stock surge just a hype bubble? We're going to unpack that, digging into a really detailed research report. We'll cover everything from their core business to valuation, even what insiders are doing.
Yeah, it's a fascinating one. You've got this incredibly powerful narrative meeting some, let's say, challenging financial realities and, frankly, quite a bit of market skepticism. By the end of this, you'll have a much clearer picture of what's really driving Bloom and its stock.
Exactly. We've split this into two main parts, covering 7 key chapters of analysis. But before we jump in, just a quick note, please do like and subscribe to the Stock Analytics AI YouTube channel. For just €4.99 a month, members get priority deep dives on specific tickers. And big news, over the next few months, we're covering all of the S&P 500 stocks. Members get first dibs. Or if you just want a one-off deep dive on a company you're curious about, just drop us a super thanks. We really appreciate the support. Okay, let's get into it. Part 1, business, management, and financials. All right, let's unpack this. First up, Chapter 1, business analysis. To really get Bloom Energy, you first have to understand the massive problem they're aiming to solve.
And that problem is, frankly, the absolutely insatiable, unprecedented demand for electricity coming from this AI boom. It's huge. The traditional power grid is already strained, seriously strained, and that leads to what people call a time-to-power crisis for data centers.
Time to power, meaning how long it takes to get hooked up.
Exactly. It can take years to get a new grid connection, and that delay, it threatens to stall the whole AI revolution. It's a major bottleneck.
Okay, so how does Bloom Energy fit in here? What's their core business? How do they actually generate revenue from this?
Right. Bloom operates on a pretty multifaceted model. It all centers around their proprietary tech solid oxide fuel cells, or SOFCs. They have 2 main strategies. First is direct sale, where a customer just buys the Bloom Energy server outright. Simple enough. But the second, and arguably more strategic, is the power purchase agreement, PPA model, sometimes called energy as a service.
PPA. Right, that sounds familiar.
Yeah, and it's crucial because it totally eliminates that massive upfront capital cost for the customer. Instead, they just buy electricity from Bloom at a predictable fixed rate, usually over long-term contracts. This whole thing is heavily supported by financing partners like HPS Investment Partners, making it really accessible.
That seems like a much easier sell for big customers like data centers, avoids that huge initial outlay.
Definitely. And these models lead to 4 clear revenue streams. You've got product revenue from the direct sales, installation revenue. Then there's service revenue. This is key. It's long-term, recurring income from operations and maintenance agreements, sometimes up to 20 years. Very sticky. And finally, electricity revenue from those PPAs we talked about.
Got it. And what about the key products themselves? You mentioned the server.
Yes, the heart of it all is the Bloom Energy server. It's their flagship. Think of it like a stationary power generation platform, like a power plant in a box. It provides super reliable 247 electricity using a clean electrochemical process. So no combustion, unlike traditional generators.
Clean and reliable. What are its main attributes?
Key things are market-leading electrical efficiency, over 60%. It's got a modular design, so it scales easily from kilowatts up to hundreds of megawatts. And huge flexibility on fuel. It can run on natural gas now, biogas, or hydrogen in the future. It's future-proofed in that sense. Then there's the Bloom electrolyzer. This is their move into the hydrogen economy. It basically reverses the server's function, uses the same SOFC platform to produce clean hydrogen from electricity and water. Still early days for this, but it's a significant potential growth area. And like I said, those operations and maintenance O&M services are really central. They create that predictable long-term recurring revenue.
Okay, this is where it gets really interesting to me. Their market position. Just how dominant are they in this space?
Well, according to research from Frost & Sullivan, Bloom Energy is the undisputed leader in stationary solid oxide fuel cells globally. Their market share is estimated at a commanding 44%. That's way ahead of competitors like Doosan Hyaxium or Fuel Cell Energy.
44%, that's huge.
It is, and by the end of 2024, they'd installed about 1.4 gigawatts of these servers, over 1,000 locations worldwide. That installed base is critical for future service revenue.
So translating that dominance, what's the core value proposition for customers? Why choose Bloom?
It really boils down to four key pillars, perfectly suited for today's energy challenges. First, resiliency and reliability. You get on-site power, totally independent of the grid, with 99% plus availability. For data centers, hospitals, that's absolutely critical. Second, sustainability. Lowers CO2 emissions, virtually eliminates nasty pollutants like NOx and sounds. And crucially, it uses zero water during steady operation. That's big, especially in water-stressed areas. Third, cost predictability. Those long-term fixed-rate contracts protect customers from volatile utility prices, helps them budget. And fourth, maybe the most potent advantage right now, time to power. We talked about grid connections taking years. Bloom can deploy and deliver power in as little as 90 days.
90 days versus 4 years, that's not just an advantage, that's almost a different category.
It's a game changer, especially for the tech sector, which moves so fast. AI waits for no one, right?
Right. So what are the broader market trends really pushing Bloom forward?
They're sitting at the confluence of some really powerful trends. The overall hydrogen fuel cell market, forecasted to grow at over 20% annually, huge. Their specific niche, solid oxide fuel cells, is projected to grow even faster, like an explosive 31.2% CAGR through 2030, reaching over $11 billion. And the primary catalyst, again, is that absolutely massive power demand from AI, just completely outpacing the grid's capacity build-out.
Okay, so huge market, fast growth. Who are the main competitors trying to grab a piece of this pie?
Well, the fuel cell market is fragmented, but key players include companies like Plug Power and Fuel Cell Energy. Plug Power is making a big bet on building an entire green hydrogen ecosystem end-to-end. Production, storage, consumption, it's ambitious. Fuel Cell Energy has a diverse portfolio, lots of patents.
So how does Bloom's strategy differ?
This is really interesting. Plug Power is betting heavily on the hydrogen molecule itself, right? Their success depends on a whole new hydrogen infrastructure getting built out, which takes time and massive investment. Bloom, on the other hand, is laser-focused on solving the immediate problem, reliable on-site power generation, today. Their servers run on existing natural gas infrastructure now, but they're ready for hydrogen later. So their model is much less dependent on that speculative, long-term hydrogen economy build-out.
That's a really key difference. Less risk today, maybe. What about the regulatory side? Is policy helping or hindering?
Oh, it's definitely a significant tailwind. In the U.S., the 2022 Inflation Reduction Act, the IRA, provides crucial tax credits. And then more recently, this fictional One Big Beautiful Bill Act, OBBBA, in July 2025, was pivotal. It restored the 30% investment tax credit, the ITC, for fuel cell property. And importantly, that includes systems running on natural gas, which directly benefits Bloom's core products right now, makes the economics much better for customers. Plus, government investment in clean hydrogen hubs. That's a long-term plus for their electrolyzer business.
So strong market position, favorable regulations. Are there significant barriers preventing others from just jumping in?
Absolutely. There are high barriers here. First, technological complexity and capital intensity. Bloom spent 2 decades and $1.7 billion refining this tech. That's hard to replicate quickly. Second, infrastructure requirements. Bloom cleverly uses existing natural gas pipelines. That's a huge advantage over hydrogen-only solutions needing brand new pipelines. And third, a pretty formidable intellectual property moat. Hundreds of patents protecting their specific innovations.
Beyond just barriers, what are their specific competitive advantages? What makes them stand out?
Well, their brand strength and recognition is top tier. We're talking Fortune 100 clients, Google, Walmart, Equinix. They even had that high-profile 60 Minutes feature way back in 2010. They're also showing cost advantages and economies of scale. Gross margins hit nearly 27% in Q2 2025, way up from before. That's manufacturing efficiency kicking in. And their plan to double capacity to 2 GW signals real confidence they can bring costs down even further.
Any network effects?
Yeah.
Or switching costs?
Not traditional network effects, no, but extremely high switching costs. Once you've got a Bloom system integrated with a long-term O&M contract, you're unlikely to rip it out. But honestly, their most powerful, unique advantage, it's still that speed of deployment, that time to power, delivering in 90 days. That's revolutionary for the AI industry right now.
Okay, that provides a really solid understanding of the business itself. Let's shift focus now to the people running the show. We're moving into Chapter 2. management valuation.
Right, and you can't really talk about Bloom Energy without talking about its founder, chairman, and CEO, Dr. K.R. Sridhar. His background is pretty unique. He actually led a NASA project focused on producing oxygen on Mars using similar fuel cell principles.
From Mars to megawatts, huh?
Pretty much. He pivoted that tech back in 2001 to create power from fuel here on Earth. He's guided the company for over 24 years now.
Through the secretive startup days, the 2018 IPO, and that long stretch of, well, not being profitable, what's his track record look like, especially now they're turning the corner?
He's definitely shown a key ability to adapt. Pivoting the company's focus squarely onto this data center power crisis was a smart move. And while they haven't posted a full year of GAAP profitability yet, they were really close in 2024. And recent non-GAAP profitability signals a major operational turning point is likely happening under his leadership. Now, it is worth mentioning, during the early days of the COVID pandemic back in March 2020, the company did pivot temporarily. They refurbished ventilators for California at Governor Newsom's request. That was a no-bid contract up to $2 million. It drew some public scrutiny at the time because Bloom had been a notable political donor. They stated they did it at cost, but, it became part of the public discussion.
Right, so transparency and ethical reputation, how do they stack up generally? Leaving aside that specific contract scrutiny,
Dr. Sridhar is very public-facing, very confident. You see him often on financial news channels really articulating Bloom's role in the AI revolution. He's a strong communicator. And recent earnings calls, they've shown what looks like a say-do culture. They've been consistently hitting or beating their financial targets. So apart from that ventilator contract episode, which they framed as helping out, the general perception seems pretty solid now.
Okay, let's talk capital allocation. Where is management putting the company's money?
Their strategy is crystal clear. Aggressive reinvestment for growth, period. The biggest recent decision, announcing that plan to double factory capacity from 1 gigawatt to 2 gigawatts by the end of 2026.
Doubling capacity, that's a huge bet.
It's a massive capital expenditure, yes. Signals enormous confidence in future demand, especially from data centers. They're betting big on continued growth. And historically, their growth has been organic. They haven't really done big acquisitions. Instead of M&A, they use a more capital-light approach through strategic partnerships, like with Duke Energy or Southern Company. The utilities buy Bloom's servers to offer to their customers. Clever way to expand reach.
Makes sense. What about returning cash to shareholders? Dividends, buybacks.
Simple answer, none. As a high-growth company focused on reinvestment, they've never paid a dividend. And they explicitly say they have no plans to start, no share buyback program either. Quite the opposite, actually. They've consistently issued new stock since the IPO to fund operations and expansion.
Okay, so all the cash is going back into growth. How effectively are they using that capital? Let's talk return on invested capital, ROIC.
Right, ROIC. For most of Bloom's history, it was negative, which makes sense. They were unprofitable and investing heavily. With the recent turn to profitability, their trailing 12-month, or TTM, ROIC is now positive. It's around 2.37%.
Positive is good, but how does that compare?
Well, here's the catch. It's still substantially below their estimated weighted average cost of capital, their WACC, which is estimated around 20.62%.
Uh-oh. So they're still technically destroying value on an overall basis.
Historically, yes. Based on that trailing ROIC versus WACC, they are. But, and this is a huge, but a backward-looking metric might be misleading here, if you look at the return on incremental invested capital, ROIC, just for the last 5 years ending December 2024, it was an astonishing 75.25%.
75%.
On new investments. Exactly. That incredibly high figure suggests their most recent capital allocation decisions have been extremely effective. The business is becoming way more capital efficient as it scales. So that ROI acts as a powerful leading indicator. It suggests the overall ROIC might be poised to rise dramatically and potentially cross that WACC threshold soon. It's a sign the economics are shifting fast.
That's a really critical point, the difference between past performance and recent efficiency gains. Okay, let's get into the numbers. Chapter 3. Financial analysis. Start us off with market cap. How big is Bloom now?
As of mid-August 2025, Bloom Energy's market cap is sitting around $10.6 billion. That puts it firmly in the large cap space. And yeah, that number reflects an absolutely explosive run-up. The stock surged over 257% in the past year alone.
Wow, 257%. Incredible. What about revenue growth over the last few years? Is it backing that up?
They've shown pretty consistent and accelerating growth. Roughly $1.2 billion in 2021, $1.33 billion in 2023, then $1.47 billion in 2024. And that growth accelerated into 2025. TTM revenue hit $1.63 billion by June 30th. Q2 revenues were up almost 20% year over year. Management's guidance for the full year 2025 is between $1.65 and $1.85 billion. So yeah, the top line is definitely growing strongly.
And profit margins, you mentioned they're turning profitable. How are those margins looking now?
This really is the critical inflection point. Gross margin for Q2 2025 hit 26.7%. That's a significant jump from just 20.4% the year before. Big improvement. Their non-GAAP operating margin for Q2 actually turned positive at 7.1%. And the bottom line, the TTM net profit margin is now positive too at 1.45%. That's even with a one-time non-cash loss they took in Q2 related to a debt exchange. So yes, margins are expanding.
But margins improving, profits turning positive. What about actual cash generation? Free cash flow?
Yeah, free cash flow, or FCF, has always been the challenge because of those heavy investments. Historically negative for years, 2024 was actually their first year ever of positive annual free cash flow, just $33 million, but still positive. However, it's still really volatile. Q2 2025, for instance, showed a significant negative free cash flow of $213 million. So generating consistent cash is still a work in progress as they scale.
So earnings consistency.
Yeah.
Have they really turned the corner, or is it still a bit uncertain quarter to quarter?
I'd say yes, the corner seems to have been turned, but consistency is still developing. After that long history of losses, the past year marks a definite shift. Becoming profitable on a TTM basis in 2025 was huge, driven by milestone quarters like their first ever profitable Q1 on a non-GAAP basis, and that massive earnings beat in Q2 2025. Posting $0.10 per share when analysts only expected 0 and 1 cent, that really got the market's attention, suggests momentum.
Okay, let's look at financial stability, debt and liquidity. How's the balance sheet looking?
This is a point of caution. Their balance sheet carries significant leverage. The debt-to-equity ratio is high at 215.5%. That's about $1.3 billion in debt versus roughly $619 million in equity. That level of debt is a key risk, makes them sensitive to interest rates.
High debt. But what about near-term cash? Liquidity.
Here's the contrast. Their short-term liquidity is exceptionally strong, very healthy current ratio of 4.99. That means they have almost 5 times the liquid assets needed to cover all their obligations due within the next year. Suggests a very low risk of any near-term cash crunch. It seemed like a deliberate strategy. Carry long-term debt for growth, but maintain a huge cash buffer for safety. It's an interesting balancing act.
High debt, high liquidity buffer.
Got it.
Yeah.
Finally, valuation. How is the market pricing Bloom Energy after that massive run-up?
Yeah, valuation is, well, it's stretched, to put it mildly. Given how recently they turned profitable, their price to earnings, or PE ratio, is astronomical. Depending on the calculation, it ranges from 367 to over 1,100.
Over 1,000 PE. Yeah. Orders of magnitude higher than the broader market. It reflects massive expectations for future earnings growth. The market is pricing in perfection, basically. Now, if we look at intrinsic valuation using a discounted cash flow or DCF model.
Right, trying to estimate its true value based on future cash flows.
Exactly. Based on educational DCF models, using reasonable assumptions like tapering growth over 10 years, a conservative terminal rate, and a discount rate reflecting its volatility. The estimated intrinsic value range comes out somewhere between $29 and $39 per share.
Okay, hold that thought. $29 to $39 intrinsic value estimate. We'll come back to that. All right, we've covered the business, management, and financials in detail. Now let's connect this to the bigger picture. Market reaction, ownership, and risks. Part 2. Let's jump straight into Chapter 4. Market sentiment. What's Wall Street saying, and how's the stock actually behaving?
This is where things get really, really interesting. Because there's a fascinating paradox here. The consensus rating from Wall Street analysts, it's generally a buy or moderate buy. They seem fundamentally bullish on the long-term story. And it's a big but their average 12-month price target falls between $25.70 and $34.57.
Wait, price targets of $25, $35, but the stock is trading around $45.
Exactly. That's the paradox. It suggests that while analysts believe in the long-term narrative, they think the stock's recent rapid surge has pushed its valuation way beyond what their models justify over a typical 12-month time frame. It's like they're saying, great company, fantastic story, but maybe wait for a pullback.
That's a huge disconnect. What's the general media tone? Are they picking up on this valuation concern?
Not really, no. The news flow has been overwhelmingly positive. The dominant theme you hear everywhere is Bloom's central role in powering the AI revolution. Key drivers highlighted are things like that strategic partnership with Oracle for AI data centers, the announcement about doubling factory capacity, and that string of record-breaking quarterly results beating expectations. The media narrative is very bullish.
Okay, positive news. Analysts like the story, but not the price. What about market indicators? Short interest. Are people betting against it?
Oh, yeah. Despite all the positive headlines, there's a significant group betting heavily against the stock. Short interest, the percentage of shares sold short, is extremely high. It ranges from 19.7% all the way up to 31.8% of the float. That's way higher than average for its peers.
30% short. Wow.
Yeah, it makes Bloom a classic battleground stock, lots of bulls, lots of bears, and it makes it susceptible to a potential short squeeze if the price keeps rising fast and forces those shorts to buy back shares. Indicates deep disagreement in the market.
And technically,
Yeah.
how does the price look compared to its moving averages on the charts?
From a technical analysis viewpoint, the stock is showing very strong positive momentum. The current price, around $45.28, is significantly above its 50-day moving average, which is down near $28.49. It's also well above its 200-day moving average, which is somewhere between $23 and $33. That indicates a powerful uptrend across short, medium, and long-term horizons. Technically, it looks very strong.
Strong technicals, but high short interest in analyst price targets way below current levels.
Fascinating. Let's move to Chapter 5, ownership structure. Who actually owns Bloom Energy stock?
Well, institutional ownership is exceptionally high. We're talking large professional money managers, pension funds, mutual funds, hedge funds. They hold about 91.9% of the shares, and it's highly concentrated, too. The top 25 shareholders control over 73% of the company. Major firms like Columbia Management, BlackRock, the Vanguard Group are big holders.
Over 90% institutional ownership. That signals pretty strong conviction from the so-called smart money, doesn't it? It certainly suggests sophisticated investors have bought into the long-term story and done their due diligence. High institutional ownership is often seen as a positive sign.
But there's always a but, isn't there? What about insiders? The executives, the directors, the people who know the business most intimately? What are they doing?
Yes. And this is where the narrative takes a very sharp and potentially concerning turn. In stark contrast to the institutions buying in, the activity from corporate insiders paints a decidedly bearish picture. Overall insider holdings are quite low, just 2.34%. CEO K.R. Sridhar holds most of that at 1.63%.
Low holdings. Okay. What about recent transactions? Buying or selling?
This is the alarming part. Recent data shows zero open market purchases of stock by insiders. None. Instead, there have been numerous and consistent sales by top executives. We're talking the CEO, the COO, the chief legal officer, all selling shares. And then the really big one. On July 10th, 2025, SK Ecoplant, a major strategic partner that owned 10% of the company, sold its entire 10 million share position for $276 million. They completely exited their investment.
Wow. A strategic partner dumping their entire stake. That sends a message, doesn't it?
It sends a very powerful message. You have this profound divergence. Big institutions are piling in, buying the AI narrative, seemingly happy to pay a premium, but the company's own top management and a key strategic partner are consistently selling, with SK Ecoplant making a complete exit.
How do you reconcile that? It's hard to ignore insiders selling, especially a partner exiting completely.
It's the central tension, really. Does Wall Street see something the insiders don't? Or do the insiders, seeing the stock price soar, think this is just a great opportunity to cash out, perhaps believing the valuation has gotten ahead of itself? This schism between what institutional buyers are doing and what the C-suite and key partners are selling is critical for any potential investor to consider. It suggests those with the deepest insight might think the current price is attractive for selling.
A very important and, frankly, worrying counterpoint. Okay, let's pull together the potential downsides. We're now in Chapter 6, Risk Assessment.
Right.
Let's start broad with a SWOT analysis, strengths, weaknesses, opportunities, threats.
Right, a SWOT gives a good strategic overview.
Dominant 44% market share in stationary SOFCs. Proprietary high-efficiency tech. Proven time-to-power advantage, 90 days. Strong brand, Fortune 100 clients. And importantly, recently achieved profitability with improving margins.
Weaknesses. That high debt-to-equity ratio, 2.15, is a big one. Historically negative and still volatile free cash flow, dependency on natural gas for most current deployments, some ongoing litigation IP risks, and a recent CFO departure creates a bit of leadership uncertainty. Opportunities. Massive demand from AI and data centers is the headline, favorable regulations like IRA and OBBBA tax credits, expansion into the hydrogen economy with electrolyzers, international expansion potential in Europe and Asia, and threats. New U.S. tariffs imposed in 2025 are hitting costs right now. High interest rates increasing capital costs, intensifying competition in clean energy, that high short interest reflecting market skepticism, and of course, a potential economic downturn could hit customer spending.
Let's drill down on a couple of those threats. First, macroeconomic factors like interest rates. How big a deal is the higher for longer environment for Bloom?
It's a pretty big deal. The clean energy sector is very sensitive to interest rates because products are so capital intensive, requiring lots of upfront investment. Higher rates increase the cost of capital for both Bloom and its customers, makes new projects more expensive, potentially causes delays or cancellations, and it makes it harder for Bloom to achieve that positive spread between their ROIC and their WACC, which we talked about being crucial for creating real economic value.
Right, makes the hurdle higher. And what about those specific U.S. tariffs of 2025? You said they're hitting costs now.
Yes, this is a direct and immediate threat. These are new, broad levies impacting components used in clean tech, like the steel and aluminum in Bloom's energy servers. It basically acts like a direct tax on their cost of goods sold. Management has already said tariffs increase costs by 4% and could knock as much as 100 basis points, a full percentage point, off their full-year gross margins.
So it puts pressure on their profitability just as they're achieving it.
Exactly. It creates this critical race. Can Bloom's efficiency gains from scaling up their new factory actually outpace these cost increases from trade policy? It's a major uncertainty hanging over them.
Okay, we've laid out the landscape, the good, the bad, the numbers, the risks. Let's bring it all together. We've reached Chapter 7. Conclusion. Let's start with the bull case. What are the key reasons to be optimistic about Bloom Energy?
The bull case is undeniably compelling, you have to admit. First, right product, right time. They are uniquely positioned to solve this acute power shortage caused by AI, offering that time-to-power advantage the grid just can't match. Second, dominant market leader, clear leader in their niche, superior tech, blue-chip customers. That 44% market share is powerful. Third, financial inflection point. After 2 long decades, they've finally hit profitability, margins are expanding, there's a clear path to growth. That's a huge milestone. Fourth, massive addressable market. The market for their solutions is enormous and growing rapidly, plus they have regulatory tailwinds like the restored investment tax credit. And fifth, strong institutional backing. That 91.9% ownership by institutions is a powerful vote of confidence from sophisticated investors.
Okay, that's a strong bull case. But what about the other side, the bearish arguments?
There's a strong bear case too, and you absolutely have to consider it. First, extreme valuation. The stock seems priced for absolute perfection, trading at a huge premium to analyst targets way above DCF estimates with that astronomical PE ratio. Second, alarming insider selling. This is a big one. Top executives consistently selling shares and a major strategic partner completely cashing out. That's a powerful negative signal from those who know the company best. Third, financial fragility. The balance sheet is highly leveraged, debt to equity over 2.0, and they have a long history of burning cash, despite recent improvements. Volatile FCF is still a concern. Fourth, external headwinds. Those new tariffs hitting margins, the sustained high interest rate environment making projects more expensive, these are real threats. And fifth, significant skepticism. That extremely high short interest shows a large part of the market is actively betting the price will fall. They see fundamental problems or risks the bulls might be overlooking.
So bringing it back to valuation specifically, where does the current price stand relative to those estimates?
Right. Based on those educational discounted cash flow models we discussed, the estimated intrinsic value range for Bloom Energy is roughly $29 to $39 per share. And as of August 17th, 2025, the actual share price is $45.28.
$45 versus an estimated intrinsic value below 40. So what's our concluding outlook for the listener trying to make sense of this?
The current share price is trading at a substantial premium, a premium to analyst consensus targets and a premium to those DCF-derived intrinsic value estimates. It seems the market has fully embraced the narrative Bloom as a primary winner from the AI energy crunch and has priced the stock for flawless execution of a hyper-growth scenario going forward. Now, the underlying business fundamentals are strong and they are demonstrably improving, that's clear. But the current share price appears to have run significantly ahead of those fundamentals, even factoring in future growth. This disconnect creates that classic battle, a powerful, compelling growth story versus a very stretched valuation, especially for new investors coming in at this level.
So what's your takeaway from this deep dive on Bloom Energy? Does that compelling AI power narrative outweigh the serious valuation concerns and those insider sales for you? Or do the risks and the high price tag loom larger right now? It's definitely a fascinating challenge to weigh that immense potential against the current market price. We really hope this deep dive is giving you that shortcut to being truly well-informed on this very complex and intriguing company. If you found this helpful, please remember to like this video and subscribe to Stock Analytics AI YouTube channel for more deep dives just like this one. And remember, members get priority access for just €4.99 a month. We're covering all the S&P 500 stocks over the next few months, so it's a great time to join. Or just drop us a super thanks if you want a specific company covered.
And just the necessary disclaimer here. This analysis was generated by an AI system, and it's purely for educational purposes. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Couldn't agree more. Thank you so much for joining us on this deep dive. We'll be back very soon with another stack of sources to unpack for you.